Your gut tells you that you should get this loan for your small business or for an asset that you're purchasing. The lending institution, like a bank, for example, feels otherwise, either denying the application fully or reducing the size of the loan on offer. One reason is that the number of data points we are now transmitting are way more than ever before, and all of these are being collected too and scanned by banks. So it may no longer be just your bank account or regular income statement which helps lenders decide how much to lend to you if they do. Knowing how this system works is important for any borrower, including you and me, and lies in the larger context of KYC regulations as well as the practice and increasing complexity of challenges faced by financial institutions and their response to it. I caught up with Ajay Trehan, founder of identity verification and due diligence platform AuthBridge, which works with financial institutions as well as organizations in the gig economy on large verification projects, and began by asking him why the traditional process of Know Your Customer or KYC was flailing and how is this changing now? Which is also suggesting to me that the traditional method of KYC or Know Your Customer and the whole process that goes into opening a bank account is flawed, fundamentally at least. It works for many people, but for those who want to game it, they are obviously gaming it. In which case, where or which aspect of that chain does the solution lie as we go ahead? Because you can't keep asking me to give more and more data and more information and my home address and my rent agreement and house purchase agreement and so on, because it's only, pointing back all to the same person, so to speak.
See, the reason why financial institutions ask you for so much data is they were trying to catch if they're not sure about anything in the initial part of the screening or the diligence process. So that's where digital solutions and digital layers come in, and which are much faster. Now, at AuthBridge, for example, we would integrate some 160, 170 parallel data points, including a lot of surrogate data points, which could help you quickly take a decision on whether this person is credit worthy or not, or should be given an insurance or not. For example, over a video call, you could detect very subtly whether this is a living individual or a deepfake. You can detect with deepfake videos today with a fairly high degree of accuracy, but that's also evolving. Now, that cannot be done in a normal, conventional way, so the solutions are evolving. There are ways to identify synthetic IDs now. There's a lot of work happening on mule accounts, but that's also evolving with more intelligence being built on, digital fingerprinting, device fingerprinting, etc. So this is a constantly evolving, and there are some solutions around it.
Right. So you as a company started out, let's say, verifying individuals for jobs that they were applying to. And I'm assuming this was at scale, and you continue to do that. That's your foundation to, let's say, go into the digital side of things and going into the banking and financial system. So at the heart of everything is the person, and the person is either a crook or a saint, as it happens. So tell us about how that is helping you, if so, in solving the problem that we are facing today.
So we, almost like 20 years of intelligence on individual data and how to detect different antecedents. And that's actually been pretty handy as we built surrogate data layers with banks and financial institutions to help them detect all kinds of current or future frauds. One of the biggest areas that we kind of solved for financial institutions was aggregation of criminal and litigation data. Now, what happens here is banks traditionally have been used to looking at credit report failures, right? So I haven't paid my previous loan on time, or I've had a few check bounces while paying my credit card. That could generate a red flag. But I may have borrowed from a private lender and not returned it. He would have filed a section 138, which is a check bouncing case against me, but that you would not know because it'll never appear in my credit report. So where AuthBridge comes in is it looks at you as an individual from all aspects. We look at your identity, which is, thanks to Aadhaar today, is a fairly simple process. But then we have to marry that identity with at least one more data point of identity to make sure that, that one identity wasn't used and the other identities are also matching. That is married with the bureau data, and that matches. But then we look at all the data available about you in the public domain, including litigation and crime data, to see if there is anything there that would impact the bank and your ability to serve the loan properly later, etc., etc. So that's where we come in. And that product originally was designed, that product's called 𝑘𝐢𝐬𝑥. It was originally designed to solve for the gig economy in India. So we are the largest player in the gig workforce screening space. Screen close to about 100,000 people every day as they get onboarded across multiple screening platforms, and they want to know identity.
You see, 100,000 people every day get screened. So every day there are 100,000 new people, or there are people who are coming back and rotating in the system?
Yeah, so people moving from one platform to another, people at writing moving into other jobs, fresh people coming in. So it's about 100,000 new enrollments on various gig platforms across the country, and they need to be taken through an identity check process, even driving licenses wherever driving licenses matter, or criminal records for sure. So that intelligence and that capability was built to solve that problem. And today we use it at massive scale with financial institutions to help them, weed out people with all kinds of negative history.
So you're working with banks, non-bank finance companies, and other financial services players to act as a layer between the customer and them and providing them this data. So one is, what is the size of this operation? I mean, how many people's accounts are you actually physically maintaining? And how often are you updating, so that the bank knows if there's something else apart from the usual check not clearing on the 2nd of whatever the month happening?
So in a typical month, we would be looking at close to about 20 million data points, 15 to 20 million data points, depending on which month is a festival season, then the number of data points we hit is much higher.
That will correlate to how many people, individuals?
Typically about 5 million. And for many of these cases, we keep a check on an ongoing basis. So whether it is an individual who's taken a loan, or it's a business that's taken a kind of working capital loan or any kind of another business loan, we would keep a watch on the profile of the customer, whether it is ongoing income, it is various other surrogate data points. For example, for business, we would look at their compliances to GST, their compliance to paying their employee PF, depositing PF on time, filing their GST and PF returns. Because usually what we've seen is when businesses go into trouble, that's the first thing where they start defaults, right? PF delays, GST delays, and then they go into loans not being paid on time. So that's an early catch. The other area to look at usually for us is number of employee count. So is that count going down? Something as silly as looking at your electricity bill, right? If it's a season where your electricity bill is normally higher than the previous months, why is it going down this month? So there must be an issue. So it's all available. It's public data. So at the point of onboarding the customer, we ask for details that we can then eventually use.